The next crypto surge is coming, and most people are going to miss it. They'll chase the hype, buy the absolute tops, and then panic sell the bottoms, just like they always do. But not you. Not this time. In this video, I'm not giving you vague predictions or chasing trends that will be gone tomorrow. I'm opening up my personal playbook. This is the exact framework I'm using to get ready for the market-altering shifts that are going to define 2026. It's a real strategy built on understanding where the big money is actually going, how new regulations are shaping the industry for the better, and which specific sectors are being quietly built to handle the coming tidal wave of capital. Forget the noise. Forget the 100x moonshots from anonymous accounts on X. Stick with me, and by the end of this, you'll have a clear, actionable plan. You'll know the sectors to watch. You'll get the big picture, and you will have a framework to be ready. So why listen to me? I'm not some celebrity investor, and I'm not going to promise you a 1000x return overnight on a new meme coin. My credibility comes from years in the trenches of this market. I've been through multiple cycles, which means I've seen incredible wins. But more importantly, I've taken some brutal losses. And those losses, they taught me more than any bull run ever could. They taught me that luck is a terrible strategy and hope is not a plan. The biggest gains in crypto don't come from getting lucky. They come from understanding the powerful currents moving just beneath the surface of the market. They come from seeing the chessboard 3, 4, or even 5 moves ahead, while everyone else is just reacting to the last move. And that brings us to the biggest problem every retail investor faces today: information overload and total strategic chaos. You're getting hit from all sides. One expert tells you Bitcoin's 4-year cycle is law. Another tells you it's dead. You hear about AI coins, DePIN, real-world assets, layer 2s. It feels like you need a PhD just to understand the jargon, let alone build a real investment plan. This chaos isn't an accident. It's designed to make you reactive. It pushes you to chase pumps and buy into hype without a plan. And ultimately, you just become exit liquidity for the smart money that does have a plan. They are counting on your emotional decisions, your FOMO, and your panic. My goal here is to foot that script, to turn you from a reactive player into a proactive strategist, to give you the clear framework that institutions use, but broken down into a simple, actionable plan. We're going to filter out the noise, focus on the signals that actually matter, and build a portfolio designed not just to survive the next surge, but to thrive in it. I'm not just here to give you a fish. I'm here to show you where the most fertile fishing grounds are and give you the right gear to succeed. The first pillar of the playbook is understanding that the crypto market has fundamentally changed. For years, the whole crypto world operated on one core belief: the Bitcoin 4-year cycle. The logic was simple, and for a while, it worked. Every 4 years, the creation of new Bitcoin gets cut in half, the halving. This supply shock, met with growing demand, would kick off a massive bull run. It was predictable, it was reliable, but I'm telling you, that playbook is now dangerously out of date. The 4-year cycle isn't dead, but it's evolving into something way more complex. Relying only on the halving calendar now is like navigating the ocean with a rusty compass when everyone else has GPS. Sure, you're pointed in the right general direction, but you're missing all the critical data that actually matters for the journey. So what changed? The single biggest factor is the arrival of the titans, institutional capital. The launch of spot Bitcoin ETFs back in early 2024 wasn't just another headline. It was a tectonic shift that rewired the market's DNA. Before the ETFs, crypto was a retail-driven game. Now, it's a global macro asset. We're not just talking about us anymore. We're talking about giants like BlackRock, pension funds, and soon, even sovereign wealth funds. This institutional demand is so huge that it's starting to overshadow the halving supply shock. Think about it. The 2024 halving cut the new supply of Bitcoin by about 450 BTC a day. But in the months after the ETFs launched, We saw single days where ETF inflows bought up 10 times that amount. This institutional money is now the main driver of demand, and it doesn't run on a neat 4-year schedule. It runs on global liquidity, Federal Reserve interest rate policies, and regulatory news. This is why you hear analysts talking about cycle extension. Instead of those sharp parabolic bull runs followed by 80% crashes, we're probably looking at longer, more drawn-out cycles. The bull market might last longer, but as analysts at Bernstein have said, it'll also be more exhausting. It will have more volatility and more sharp corrections designed to shake you out. The massive cash injections from institutions can push the market higher than ever, but their program trading can also create deeper, faster pullbacks. What does this mean for your strategy? It's profound. You can no longer just buy after a halving and wait 18 months to sell. That's a recipe for disaster. Instead, you need to think like the new players. You have to watch macroeconomic trends. Is the Fed cutting rates and pumping money into the system? That's a massive tailwind for crypto. Is the US dollar index DXY looking weak? That has historically been a huge green light for Bitcoin. This new reality also changes how we think about risk. In past cycles, Bitcoin had those devastating 80 to 85% drawdowns. While crypto will always be volatile, the presence of huge institutions accumulating for the long term creates a much stronger and higher floor. These massive entities see big dips not as a reason to panic, but as a generational buying opportunity. This means the brutal, extended bear markets of the past may be a thing of the past. So, the first pillar is to throw out the old simple cycle map. We have to embrace this new multi-factor reality. The halving is still a piece of the puzzle. It's a great story and a real supply constraint, but it's no longer the whole picture. The real picture is a mix of institutional flows, macroeconomics, and global liquidity. Understanding this is the first step to positioning yourself for 2026. You're no longer just a crypto investor. You're a macro investor whose chosen asset is crypto. The second pillar of our playbook, and maybe the most misunderstood catalyst, is regulation. For years, the word regulation made every crypto investor nervous. It meant crackdowns, uncertainty, and fear. But that era is ending. The narrative has flipped. Today, regulatory clarity isn't a threat. It's the single greatest accelerant for the next wave of capital. For the last few years, the US approach has been regulation by enforcement, basically suing people to make a point. It created a chaotic environment and pushed a lot of innovation overseas. But the tide is turning fast. There's a growing bipartisan agreement in Washington that this approach has failed and that the US needs clear rules for crypto to stay competitive. We're seeing this happen in real time. You've probably heard of bills like the Lummis-Gillibrand Stablecoin Act or the Guiding and Establishing National Innovation for US Stablecoins, Genius Act. The names are a mouthful, but the direction is clear. We saw a landmark moment in March 2025 when the Genius Act passed the Senate Banking Committee with strong bipartisan support. A huge milestone for crypto law. Senators from both parties, like Cynthia Lummis and Kirsten Gillibrand, have been working nonstop, saying they believe a stablecoin bill could hit the president's desk very soon. Why is a stablecoin bill such a big deal? Because stablecoins are the pulps of the digital economy. They're the main bridge between old finance and new crypto. A federally regulated, fully backed US dollar stablecoin is the ultimate green light for big corporations and banks. It removes risk and gives them a safe, compliant way to move billions of dollars onto the blockchain. In fact, economists like Stephen Miran have projected the stablecoin market could swell to $3 trillion. A force so large, it could actually push down US interest rates by increasing demand for the treasuries that back them. That's how big this is. Crypto is getting woven into core US monetary policy. Beyond stablecoins, we're seeing similar progress on a broader market structure bill. Drafts in the House and Senate are trying to finally provide a clear definition of what's a digital commodity versus a digital security. This would give the CFTC clear authority over commodities like Bitcoin, ending the turf war with the SEC and paving the way for exchanges to operate with clear rules. This regulatory clarity is what unlocks the next $1 trillion of institutional money. These large conservative funds don't move on hype, they move on legal certainty. They need to know they're operating within a government-approved framework. That framework is being built right now, brick by brick, in Washington, D.C. Finally, let's talk taxes. Nobody likes them, but tax clarity is also a huge sign of progress. The IRS is rolling out a new form, the 1099-DA, for digital assets. Starting with the 2025 tax year, crypto brokers will have to report sales to you and the IRS. By the 2026 tax year, they'll also have to report your cost basis, just like with stocks. Is it a hassle? Sure. But is it bullish? Absolutely. Standardized tax reporting makes crypto a legitimate asset class. It removes a major headache for financial advisors who've been hesitant to recommend crypto to their clients because of the confusing tax situation. So, when you see headlines about crypto regulation, don't react with fear. That's the sound of the floodgates opening. Every sensible new rule is another signal to the biggest players in finance that the crypto market is officially open for business. This is the foundation the 2026 surge will be built on. Okay, now for the exciting part. Which specific sectors are poised for explosive growth? It's not enough to just be bullish on crypto. Real wealth is made by spotting the dominant trends before they go mainstream and getting into the leading projects within them. For the 2026 cycle, my playbook is focused on 3 areas with undeniable momentum: the convergence of AI and crypto, the tokenization of real-world assets, RWA, and the rise of decentralized physical infrastructure networks, or DePIN. First up, the undisputed heavyweight champion of tech trends, AI and crypto. This combination isn't just a story. It's the birth of a new, decentralized, intelligent economy. The whole point is to break the stranglehold that big tech has on AI. Blockchain is the perfect tool for this, allowing for things like decentralized AI marketplaces, verifiable data ownership, and smart AI agents that can operate and transact on their own. The biggest example of this is the Artificial Superintelligence Alliance, ASI. This was the historic merger of 3 top AI crypto projects: Fetch AI, FET, SingularityNet, AGIX, and Ocean Protocol, Ocean. The merger, which started its rollout in July 2024, combines their unique strengths to create a decentralized powerhouse alternative to big tech's AI. This isn't some far-off dream. It's happening right now. And the combined ASI token represents a major force in the market. Another key player in AI is BitTensor, TAO. BitTensor has a different approach. It's creating a peer-to-peer marketplace for machine learning intelligence. Basically, it lets different AI models collaborate and learn from each other, rewarding them with TAO tokens for the value they provide. It's like a decentralized global brain, aiming to speed up AI innovation outside of corporate walls. The second major sector is real-world asset, RWA tokenization. This is arguably the biggest and most tangible bridge between traditional finance and crypto. The idea is simple but revolutionary. Take real-world things like real estate, private equity, and especially US Treasury bonds, and turn them into tokens on a blockchain. This unlocks instant, global, 24/7 liquidity for assets that are normally very hard to sell. The 800-pound gorilla here is BlackRock. The world's largest asset manager didn't just dip its toes in, it cannonballed. Their BUIDL fund, launched on Ethereum in March 2024, is a tokenized fund holding cash and US Treasuries, and it quickly became the largest of its kind in the world. BlackRock has since expanded BUIDL onto multiple blockchains, showing their deep belief in a tokenized future. When the CEO of BlackRock says all assets will eventually be tokenized, you listen. This is no longer a crypto fantasy. It's the explicit strategy of the most powerful financial institution on Earth. Projects building the plumbing for this, like Origin Trail, Track, which verifies real-world data for things like supply chains, are set to become critical infrastructure in this multi-trillion-dollar shift. The third sector, and maybe the one with the most grassroots potential, is DePIN, Decentralized Physical Infrastructure Networks. This is all about using crypto tokens to incentivize people to build and run real-world infrastructure. Instead of a giant company like AT&T building a 5G network, DePIN projects pay individuals around the world in crypto to contribute their own resources, like a wireless hotspot, spare computer power, or unused hard drive space. This creates infrastructure that's more resilient, democratic, and often way cheaper than the centralized version. We're already seeing this with projects like Helium, HNT, which has built a global wireless network for IoT devices powered by thousands of individual operators. On the computing side, you have Render, a decentralized network of GPUs for graphics rendering and AI, a service that is in ridiculously high demand. For data storage, there's Filecoin Phil, FIL, the world's largest decentralized storage network. The DePIN narrative is so powerful because it's real. It's about using crypto to build actual things in the physical world, and the growth here has been explosive. These three sectors, AI, RWA, and DePIN, aren't just hype. They are backed by massive tech trends, institutional money, and clear, real-world use cases. This is where the smart money is getting positioned for 2026, and it's where our portfolio's real growth will come from. So, having a list of hot sectors is great, but it's useless without a strategy for how to actually invest. This is the how-to pillar, where I walk you through my personal approach to building a portfolio, deciding when to buy and sell, and managing risk. This is what turns theory into action. My whole strategy is built on a classic investment model I've adapted for crypto, the core satellite model. It's designed to capture the insane upside of this market while still protecting your capital with a stable foundation. First, the core. This is the bedrock of my portfolio, making up 50% to 60% of my total crypto holdings. For me, the core is just two assets: Bitcoin, BTC, and Ethereum. That's it. Bitcoin is my digital gold, my primary store of value. It's the most decentralized, secure, and institutionally recognized asset in crypto. When the big money finally comes in, Bitcoin is their first stop. Ethereum is the other half of my core. If Bitcoin is digital gold, Ethereum is the world's decentralized computer and settlement layer. Nearly all the exciting apps we just talked about in AI, RWA, and DePIN are being built on Ethereum or its scaling solutions. With its transition to a deflationary asset, ETH has become like a productive, yield-bearing digital bond. It's the foundation for the new internet. Next, the satellites. This is 30% to 40% of my portfolio. This is where we aim for higher growth by targeting the sectors we already identified. I don't just buy random coins. I create themed baskets. For example, the AI basket. This would include a big position in the new Artificial Superintelligence Alliance ASI token. Since it's a consolidated giant, I'd pair that with a position in BitTensor Tau for its unique approach. Okay, the RWA and DePIN basket. This focuses on the infrastructure plays. A project like Render for decentralized computing is a must given the demand from AI. I'd also include Filecoin for storage and Helium HNT for wireless networks, as they are proven leaders in the strongest narratives. Finally, the speculative plays. This is the smallest slice of my portfolio, just 5% to 10%. This is my high-risk, high-reward zone. This is where you might find a 50x or 100x return. But you have to be completely okay with losing this entire amount. My rule here is not to chase tips from social media. It's to use this small allocation to experiment with new, tiny projects in the narratives I already believe in. For instance, I might put a very small amount into a brand new DePIN or AI project if it has a great team and tech. The goal is to hold a few lottery tickets, knowing most will fail, but one or two could deliver returns that have a real impact on the whole portfolio. Now, for entry and exit. This is where most people mess up. My entry strategy is simple and unemotional. Dollar cost averaging DCA. I don't try to time the absolute bottom. I make regular, scheduled buys into my core and satellite positions, especially when the market is boring or fearful. This lets me build my positions at a good average price over time. The exit strategy is even more important. You must have a plan to take profits. Hope is not a strategy. My plan is tiered. When a satellite investment hits a 3x or 5x, I sell enough to get my initial investment back. Now I'm playing with house money. The rest of that position is pure, risk-free upside. As the bull market continues, I will systematically sell off my positions, maybe 10 to 20% at a time, at price levels I've set in advance. Where do those profits go? They get rebalanced. Some might go back into my core BTC and ETH holdings to compound for the long term, but the majority gets rotated into stablecoins. This locks in my gains and builds up a war chest of cash that I can use to buy aggressively during the next major crash. This disciplined, rules-based system takes emotion out of the two most important decisions, when to buy and when to sell. It gives you a clear plan of action. No matter what the market is doing, we've covered the cycles, the regulations, the sectors, and the strategy, but this final pillar is what holds it all together. It's the least technical, but it is by far the most important. Your mindset. You can have the perfect plan, but if your psychology is weak, you will fail. The market is a machine designed to move money from the impatient to the patient, and getting your head straight is the only way to be on the right side of that transfer. The first, most crucial element is conviction. When you truly understand why you invested in something, its purpose, its edge, its role in the future, you become resilient to price swings. When the market inevitably drops 30%, and it will, people with no conviction panic sell their bags to someone who has it. People with conviction see a discount, a buying opportunity. Your research is the source of your conviction. The second element is fighting shiny object syndrome. In a bull market, a new hyped-up project will launch every single day. Your social media will be full of stories about people making 100x on some coin you've never heard of. This is a trap. It's designed to make you doubt your own strategy and chase someone else's pump. You have to be disciplined enough to stick to your playbook. It's better to get rich slowly with a plan you understand than to chase 1,000 lottery tickets and end up with nothing. Third, you have to embrace patience and a long-term view. We're talking about a strategy for 2026. That's not tomorrow. There will be weeks, even months, of boring, sideways price action and scary dips. Those are the periods where fortunes are made. That's the accumulation phase, where the patient investor builds their positions while the impatient gets shaken out. The crazy, euphoric pumps everyone dreams of are the shortest part of the cycle. The real work is done in the quiet moments. This is a marathon, not a sprint. Finally, you have to internalize that price is not value. The price on any given day is just market sentiment. The true value is in the technology, the network, and the problem it solves. By focusing on the fundamental value of your investments, you disconnect your emotions from the daily price chart. You become an owner, not a gambler. This playbook is your map and your strategic framework, but your mindset is the engine. It's the discipline to follow the plan, the conviction to hold through the storms, and the patience to let your thesis play out. Without this pillar, the others will fall apart. So there you have it. My complete playbook for the next crypto surge. We've walked through the 5 pillars that will separate the winners from the losers in 2026. First, we understand the new market reality. The old 4-year cycle is changing. It's now a game of institutional flows and macroeconomics. Second, we decipher the regulatory tea leaves, knowing that clarity is the ultimate catalyst for institutional money. Third, we target the top sectors where smart money is flowing: AI and crypto, real-world assets, and decentralized physical infrastructure. Fourth, we execute a personal strategy using the core satellite model, building a stable base while capturing explosive upside. And most importantly, we have a plan to take profits. And finally, we cultivate the millionaire minting mindset, the conviction and patience needed to actually follow through on the plan. This isn't just about predicting what's next. It's about having a system to capitalize on it. The opportunity between now and 2026 will be life-changing. And now, you don't just have a vague idea of what's coming, you have the playbook.